Calibre Mining has posted their first quarter financial results, and well, let's just say we might have an idea as to why they decided to up and sell themselves. Unsurprisingly, there's more delays at Calibre's Valentine Mine project, despite receiving an update mere weeks ago on the project. Oh, and now costs are rising too. The bright side here is that the other bits of the business are holding up decently amid the delays. Let's dive in. Calibre Mining in the first quarter posted top-line revenue of $203 million, an increase of 54% on a year-over-year basis, but flat on a quarter-over-quarter basis. The revenue improvement was off the back of 72,000 ounces of gold being sold versus 62,000 ounces in the year-ago period. The average realized price of gold, of course, was up as well, which moved from $20.92 to $27.96 an ounce on a year-over-year basis. Things weren't as rosy when comparing the results to the fourth quarter of 2024, however, with gold ounces sold down from 76,000 ounces, with those ounces sold at an average price of $26.16 an ounce. Cost of sales ballooned on a year-over-year basis, growing from $103 million to $123 million. However, it was not near enough of an increase to offset the revenue gains experienced, with earnings from mine operations improving from $29 million to $79 million on a year-over-year basis. Net earnings improved from a loss of $3.6 million or 1 cent per share in the year-ago period to positive $23 million or 2 cents per share in the first quarter of 2025. Adjusted earnings, meanwhile, improved from $5.6 million or 1 cent per share to $40 million or 5 cents per share. Adjusted EBITDA was a bright spot in terms of earnings, coming in at $101 million versus $37 million in the first quarter of 2024 and $96 million in the fourth quarter. Cash flows, however, saw a much less dramatic improvement, with operating cash flows improving from $46 million to $54 million. The fourth quarter comparatively saw operating cash flows of $91 million. Calibre ended the quarter with cash and cash equivalents of $177 million, as compared to $131 million as of 2024 year-end. Adjusted net debt, meanwhile, came in at $164.7 million, as compared to $165.2 million as of the end of the fourth quarter and $241.5 million as of the end of Q1 2024. Okay, let's move on to the production data. Calibre in the first quarter of this year produced nearly 72,000 ounces of gold, a 16% improvement over the 62,000 ounces produced in the first quarter of 2024. Growth was seen at both the Nevada and the Nicaragua operations, with Nevada accounting for 7,000 ounces of gold production at an average grade of 0.31 grams per ton, versus 6,700 ounces of production in the year-ago period at grades of 0.37 grams per ton. Nicaragua, meanwhile, produced 64,000 ounces of gold at an average grade of 4.14 grams per ton, which was an improvement in terms of both grade and ounces year over year, from 55,000 ounces at 3.32 grams per ton. Guidance this year is calling for consolidated production of 230,000 to 280,000 ounces, excluding Valentine, with Calibre currently on pace to beat the upper end of that guidance. In terms of costing, total cash costs declined both quarter over quarter and year over year, coming in at $12.21 an ounce versus $12.45 in Q4 and $13.37 in Q1 of 2024. All-in sustaining costs experienced similar improvements, with AISC hitting $13.89 an ounce in the first quarter of 2025, as compared to $14.23 in the fourth quarter and $15.55 in the first quarter of last year. Guidance, meanwhile, is calling for total cash costs of $1,300 to $1,400 an ounce this year, alongside AISC of $1,500 to $1,600, both figures which are currently being beat. In fact, Q1 was actually a strong quarter for Calibre, if not for the problems at Valentine. First gold is now expected at the end of the third quarter at the Valentine Mine, despite the company stating just weeks ago that the first ore would be processed early in the third quarter. To add to it, costing has also increased, which was blamed on lower than planned productivity alongside minor scope growth. A further $80 million has been added to initial project capital since the last update on the hard figures in October. 75% of that increase is said to be related to poor productivity, while 25% is blamed on scope growth. Initial project capital, however, is said to be fully funded still, with $73 million remaining to be spent versus a cash position of $203 million. Mass construction is said to be materially complete, with final electrical, piping, and instrumentation activities remaining at the processing plant. The primary crusher has been commissioned and is expected to be ready to receive material at the end of May, with ore currently being stockpiled. Mine and mill staffing has also been completed. All that being said, this is a large mine, and a few weeks' delay at this stage isn't a huge deal. The asset is expected to produce 200,000 ounces of gold annually. While we're all anxious to see it hit commercial production, there's no sense in rushing things when we're at the 1 yard line, which might be a terrible analogy to make here, but you get the point. All right, so let's wrap it up. Calibre, aside from the delays at Valentine, had a strong quarter. That performance unfortunately was overshadowed by the delays, and also the additional capital spend requirements certainly didn't help the matter. There is, of course, also the merger with Equinox, who did not have strong results this quarter for a number of reasons. But that's a discussion for a different video that we'll have out in the coming days. All right, everybody, thanks for watching. As you guys can tell on our channel, we are in the thick of mining earnings season. So if there are any mining earnings videos that you're looking for, check out our channel. If there's stories we haven't covered that you want us to, please let us know in the comment section. Guys, if you enjoyed this content, also do us a favor, smash that like button, subscribe, ring that notification bell. Thanks for watching, everyone.